Cypress Development Corp. is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp. Trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. Welcome back to the show, Bob.
Yeah, Jim, here we are. It's Friday again, and it's been a fascinating week in the markets.
Bob, we've been flooded with questions, so we might as well get to them right away from our listeners. Bob recently stated that there will be a precious metals bull market for about the next 20 years. Could Bob expound on that time frame? What are the indicators that this will take place between 2020 and 2040? Any idea how far gold and silver will go over that lengthy period of time?
Joe, yep, that's a good one. Gosh, you can't imagine or invent financial history. All you can do is review it, and this was done decades ago. And the pattern has been you run up to a huge high in commodities, of which the latest was 2008. And then about in the ninth year later, you have a great bubble, excited climax. So that's the basic pattern. And this financial bubble is struggling, and it will roll over. And so where on the near term, and relates to gold, which the question is about, is that in the final stages of a great financial bubble, the real price of gold goes down. And by that I mean the price of gold deflated by the consumer price index in the senior currency. And so this is what we had. Actually, the last high for gold's real price was in 2011, when the whole play was very excited. And then it came down, but it's in the last year or so, you can say that the real price of gold is basing. And then if we get into financial difficulties in the fall, that will really break the price of gold's real price out. It'll rally. So here's the pattern on, there's been 5 of those great bubbles from 1720 to 1929. So recent is number 6, but it's not over yet. The collapse hasn't happened. But out of 4 out of the 5 previous long post-bubble contractions, the real price of gold went up quite consistently, and that was when the contraction was on, and oddly enough, they all lasted around 20 years. So the way to measure the low of a great contraction is the low in nominal interest rates in the senior currency, long dated, or that would be confirmed by a low in a wholesale price index or a low in commodities. And they've been about 20 years. So that's how you say, okay, now as this bubble concludes, it's setting up a bull market for gold's real price, and it could last for 20 years with some variation in it as you still go through the ordinary business cycle, the 3 to 4 year one. And quite likely on this coming period, the recoveries will be weak and the recessions will be strong. But within this, you get gold rising. So it's fascinating how it works out. And the question is right to the point. And then we had another question.
The question, silver has been on steroids these past 2 months. Is silver the new Bitcoin? Assuming a severe market correction this fall, will silver sell off with the industrial metals or be a safe haven like gold and the U.S. dollar?
That also is a good question. And again, we've got history. And the history of the gold-silver ratio is that in a rally for both metals, silver will always outperform gold. So let's flip it around the other way, the silver-gold ratio. So it goes up, and as silver outperforms gold. And the interesting part is technically is to take the momentum on the silver-gold ratio, and that's the daily RSI. And if it gets up to 80, it's getting pretty high. And in 2011, at that mania for precious metals, it was up to 92. And the only other time it had been that high was in the very fateful January of 1980, when a long bear market followed. So the precious metals have been doing the right thing. Now, what you have here is that in each contraction in the past, silver has underperformed gold. So the gold-silver ratio goes up, and that has been consistent. And each recession, each long contraction period, the gold-silver ratio has got higher. So we're looking for the gold-silver ratio to go up to 120. So, and here for our questioner is that the rally in silver for the last couple of months has been on because the gold-silver ratio got too much, and then now it needs to go volatile, which it has done. And then the next leg up in the gold-silver ratio will be suggesting a financial problem. But you can have a day, maybe in September, late September, where on one day silver is down very sharply relative to gold, and that'll be telling you that some financial pressures are just around the corner. So good question, and thanks for it.
And a third question for Bob from our friend Frank in Belgium. Everyone noticed the inverted yield curve. Everyone talks about the deteriorating economic numbers. Everyone sees the recession risk and high valuations. And pretty much everyone is convinced of a pending decline in markets. In the meantime, the gold is going to 5,000 crowd is back alive. Is that not the moment when the exact opposite happens? It scares me to see so much consensus.
Oh, yeah, Frank. That's a good one. Yeah, the inverted yield curve and interest rates are fascinating because in any boom, any expansion, short rates go up, market rates of interest go up. But then when the market gets a little worried, it focuses on short rates rising, and it worries about it. And I always point out that so long as the Treasury bill rate is going up, it says that the boom is on. So you don't worry about it. And then of course, the yield curve, which is the difference between long rates and short rates, is part of that. And in a boom, or let's put it this way, in most booms, the curve will invert where short rates are higher than long rates. And over the last few months, there's been times when portions of the curve have been inverted, and the street gets all sweaty about it. But we don't, because the flattening curve, and flattening means that and the end result of extreme flattening is inverted. That tells you that the boom is on. And in the curve, it's important to understand that when it fully reverses to steepening, that will be part of the contraction. But I've got the yield curve in the U.S. back to the 1850s. And just to refresh my mind, I looked it up the other day, and in 1929, the curve did invert, and it did change to steepening. but you really couldn't trade off of it. And then also looking in 1873, the same thing, the curve inverted and reversed and to steepening, but also it wasn't timely for trading off of. So the better one in the credit markets has been the credit spreads, which is the difference between high-grade bonds and low-grade bonds. And in May, we had the turn from narrowing, which is party time, to widening. So we had the first breakout in May, and then a few weeks ago we had the second and the dreaded breakout to widening, and that then was part of the hit, the stock market. So in this question, it's appropriate, but the Treasury bill rate and the curve inversion, the street worries overly about it and is missing the message. It's when it changes, the T-bill rate changes, that it's important. And the Treasury bill rate reached its high on this whole move in March, and it's been declining significantly since. And to us, that's saying that the boom is over. And then now you have faltering stock markets, which is also saying that perhaps the boom is over. Thanks for the questions.
We'll have more with Bob Hoye right after the break.
Grand Portage Resources' Herbert Gold Project in southeast Alaska highlights increased gold resource, indicated and inferred, of 860,000 ounces, in excess of 10 grams per ton gold. Expansion drilling is planned on the Herbert Gold property for the summer of 2019. Grand Portage Resources trading symbols are GPG on the TSX Venture, GPTRF on the OTCQB, and GPB on Frankfurt. For more information, please visit our website, grandportage.com.
Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome back. We're speaking with Bob Hoye. Bob, China with a slowing economy, they're now talking about stiffer currency controls. What does that tell us?
It's scary, Jim. A few months ago I was looking at the weakening Chinese currency and thinking that, this is policy that's part of the trade struggles and all that sort of stuff. And then suddenly woke up to what it is it's part of the contraction. And earlier in the year, you had the problems, dramatic problems with Argentina and Turkey, where suddenly they were running out of reserves, U.S. dollar reserves. So that means their currency goes down and their bank rates go up. So it's a sign of a contraction. But because the Chinese deal is so big, I got distracted for a while thinking, it's policy, it's push-shove sort of thing, and then realized, this is a classic sign of contraction. And the way it works is that I used to call it lesser exchanges, because you've got the senior exchange in New York now, and another senior exchange, of course, is London. But when you've got countries as big as China and as big as India, you can't say a lesser exchange anymore. So I taken to outlying exchanges, and this is where history is also interesting, because 2,000 years ago, the Roman writer Cicero, he wrote that if there was a financial problem in the eastern provinces, meaning, eastern Mediterranean, Phoenicia, if there was a financial problem there, it would eventually hit the financial capital, then Rome. And there's so many examples of that since. So, thus, when earlier in the year you read about Argentine currency suddenly dropping and the central bank raising rates, that is an outlying exchange, and then it was Turkey, then it was India, and then now I belatedly realized it's China. And this, Jim, is very serious. So even here now, the authorities in China are concerned about this weakening Chinese currency. So it's showing that it's not policy, but market forces. So they want to defend the currency, so they're coming in with currency controls. You can't take your money out of the country. And that's sad to see, but so it's very important when a huge outlying economy such as China is showing the same distress that a small country like Argentina is, and it's classic. So I think that this then will hit the senior market, let's say both New York and London. And when does it usually hit? In the fall. So here we are. It's not a pretty picture, and the Chinese are not, of course, not doing the right thing about it. This is to constrain capital will help push capital out of that country, and the capital will go to a safe haven, the most liquid items, which are U.S. Treasury bills and gold. And so then you have this, the other problem is in a contraction, is that people go to the safe haven of Treasury bills. That means there's not just a bid for the Treasury bill, but there's a bid for the U.S. dollar. So then in a post-bubble contraction, the senior currency becomes relentlessly firm. And it's going to be fascinating to watch. The other thing is that, of course, with the gold providing a liquid place, there's going to be a bid for gold as well. But this has worked well. Sure, we've had a terrific rally for gold recently and for silver in U.S. dollar terms, but it's been even better in lesser currencies. So, but if you one always trading gold in U.S. dollars, you then have to be kind of wary that it ain't going to be a one-way street. As a matter of fact, the rally in gold through the summer has been stronger than you'd think it would require a weaker dollar to have that kind of a rally. So gold has been acting well without a collapsing dollar, which shows that the thesis is right, that the careful money will go to the most liquid items. But what we're worried about here now, Jim, is that there could be a liquidity problem discovered this fall. So the everything bubble, we've been talking about maybe the everything liquidity problem, and that could be discovered in maybe later September, because we've had our theme at the beginning of the year was that you'd have sunshine in most markets out to around mid-year, and then August would be a turn to twilight. And yes, that hit to the financial markets it wasn't sunshine. And then you've got the probability of the dreadful twilight zone being discovered in the fall. And that's not that many weeks away. The markets are nervous. The policymakers, in the case of China, and coming in with currency constraints, are just plain being stupid. And we can see what other stupidities they can do. The other one we're interested in is at the moment the party is in safe haven items like the long treasuries and long Government of Canada bonds, also high grade bonds. And you've got headlines about this. Here, in July, the big firm J.P. Morgan said that 10-year yield is heading all the way to zero. And then in the middle of August, former central banker Greenspan says that there's no barriers to prevent negative treasury yields. So this, of course, is the phenomenon of recent times is that in Europe, from 10 years out, the interest rates have gone negative, and that on a nominal basis, and that's never happened before. So this is what it was like in June of 2016 when a powerful market for long treasuries and long Canada bonds, and there was then with 3% yields in North America, they were going to go to zero, such as you then had in Germany. And we looked at the technicals and figured that the U.S. market was less rigged than the German market, and that these technicals would be effective and reverse the hot action, which indeed was the case. The 30-year bond in Germany went from, this is just memory now, it was 0.40% to 1.4%. Huge move. And now they're sort of like minus 0.050. I think the Swiss is minus 0.75. But, so they're absurdly low. And we're getting all the technical signals on the bond future and on high-grade bonds. They're at the moon, so to speak. And there's another trick in here, Jim, that seasonally on the long U.S. bond, the bond future, it can set a high in late August. Is this late August? Yep. And then it can take another try at a rally in late September, and then you have a seasonal decline in bond prices. So this is a fabulous opportunity to shorten term in a very hot bond market. Not all at once, like not tomorrow, or I should say Monday, but over the next period we'll be lightening up on long bonds because the party has been fabulous. We're getting technical readings, unseen in 20 years on this thing, and at highs where you have seen important sell-offs follow. So, gosh, Jim, this week in the markets has been fascinating.
We'll have more with Bob Hoye right after the break.
I'm Douglas Mason, CEO of Naturally Splendid, symbol NSP on the TSX Venture Exchange. Naturally Splendid is a biotechnology and consumer products company focused on the global cannabis and health markets. Naturally Splendid is expanding distribution in this rapidly growing market with products currently in Canada, the USA, South Korea, Germany, and Australia. To view our comprehensive company presentation and for more information, please visit our website at naturallysplendid.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Bob Hoye. Bob, J.P. Morgan is saying if you think negative interest rates in North America are unrealistic, they're not saying that at all, are they?
No, it is wildly speculative, and the reason for negative interest rates in Europe is that the smaller market and the central bank has been so aggressive in buying, and then of course institutional money has been also buying, and the theory is absurd that central bank injects credit into the market, and that forces a business expansion. And that is called a primitive syllogism, and it's the same explanation that the rooster crows in the morning and the sun rises. So the logic in intervention of central banking is hopeless, but the result is that you have the absurdity of negative nominal interest rates. Now, we're going to be careful on this because nominal means what the interest rate is as you see it. And then the other one is where you then correct the interest rate for the rate of inflation. And then that's called the real interest rate. And in the past, in great bubbles such as we've been in, that long-dated real interest rate can go negative. A couple of the booms, it was as negative as -7%. But the key on this one, Jim, is that when the contraction comes in, the increase rates can be enormous. It can be in the order of 8 to 12 percentage points. So when you're talking a negative interest rates of half of a percentage point and a potential increase of 8 to 10 percentage points, it'll overwhelm the nominal quite readily once it starts. So this is going to be one of the most fascinating moments in financial history. You've had many stock booms in the past and busts, but you've never had long bonds trade down to minus and then go into a bust. So I think it's going to work. I think, and what'll mess it up will be the rise in real long interest rates. So, Jim, we're going to have a very interesting fall.
Bob, thank you so much for chatting with us.
Hey, good to be with you, and look forward to next week.
My guest has been market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. As you just heard on the show, we do take listener questions and answer them. If you have any questions for Bob or any of our other guests, you can send them to info@howestreet.com. Our YouTube channel is Talk Digital Network. Find us on Twitter @HowStreet. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.